It was February of 2020. I had a tenant. I gave him multiple warnings, burnt down one of my fourplexes. And about 3 days later, I posted, I remember on Facebook, I said, does anybody know anything about self-storage? I'm done with tenants and toilets. Today, we sit at 7 facilities, mostly in eastern Kentucky, but we target the state as a whole, 116,000 square foot, 800 doors.
By the time you're 30, you're going to be further than I could have ever even imagined by the time, I was 30. And that gets me really excited. Welcome everybody to Self-Storage Income, and I am excited for this guest podcast today. Lots of times we have individuals that come on here and they are, well, I don't know how else to say it, so I'm going to say it, old. And so I'm really excited today to have Dillon here with us because he is 27 and this is a podcast of celebration because he has big things he's doing right now, and his life is going to change dramatically. So with that, Dillon, how you doing, man?
Hey, Jay, I'm doing great. I really appreciate the opportunity to be here today. Long-time listener, so this is kind of a pinnacle event for me since I just started in a storage really in 2020. So this is kind of a long time, short time coming kind of thing. So very excited to be here today.
First thing I want to hit on right away, you are a firefighter, right?
I actually retired, technically, I guess you could say retired. I don't really like using that term. Essentially, I'm a quitter, I guess is how they would probably term it, as of about mid-May, more or less, when my wife and I kind of started in the business. We started with the idea that if and when we got to a point that, we started having kids and I decided to step away from kind of the emergency work, we had that opportunity. And luckily, we were able to realize that actually in May, and we had our first daughter in March.
And that is why we're celebrating having you on here. I mean, yeah, dude, 27, you had a baby in March, and you retired, or whatever. You don't need a job by May.
Yeah.
So
yeah,
that's amazing. Congratulations. I just like it. This is what it's all about, right? This is what we talk about, how you're able to achieve something like that. I mean, that gets me really excited, man. And I just want to say congratulations to you and your now family. And that's amazing. Let's get started. So you obviously, 2020 is when you started investing in storage, but give us some background here. How did you achieve this? What was the process?
Yeah, crazy story. So I've always kind of described my entrepreneurial journey as like a kind of a series of dominoes, kind of falling and kind of starting with small dominoes, and they kind of built up momentum to hit larger dominoes. I mean, this starts all the way back. I grew up in an entrepreneurial family. My grandmother owned a florist, and as a kid, I mean, I peddled things to customers when they came in because I had that cuteness factor, so I tried to sell them anything I could. And long story short, that turned into when I was about 16 in high school. I started a detailing company, started working for a car lot, realized they made a lot of money selling cars. So I started flipping cars. Flipping cars turned into building enough money to get my first rental property. Couldn't stand it. It was awful, was losing sleep, decided to flip that property, made some money, and then kind of took a sabbatical while selling property for some time. Then I got into small apartment buildings, got back into residential, had 3 fourplexes at one time. Let me see, probably it was February of 2020. I had a tenant. I gave him multiple warnings, burnt down one of my fourplexes. And about 3 days later, I posted, I remember on Facebook, I said, does anybody know anything about self-storage? I'm done with tenants and toilets. And sure enough, I had somebody in my local network that kind of invested in some storage. I took him out for lunch. I've always joked that I took more millionaires and billionaires out for coffee and lunch than, anybody I know. And kind of just started calling around. I got very lucky, more or less within the first probably 10 calls. I found a property that they were interested in selling. I mean, looking back on it, it was a grand slam, really catapulted me into it. First facility I bought about $20 a square foot. It was operating and cash flowing. I mean, day one. I bought it all in with renovations for $300,000. Appraised it a year later. Appraised for, I want to say it was right under $700,000. Pulled out a large chunk of change, more or less, and kind of been snowballing that into property since. So today we sit at 7 facilities, mostly in eastern Kentucky, but we target the state as a whole, 116,000 square foot, 800 doors.
Amazing, man. That's so awesome. It just, one after another rolling.
It's been kind of a change. So I mean, my goal's obviously to buy as much as we can, but we've acquired about one biannually, roughly. We've been trying one a quarter, but it's shaking out to about one every 6 months roughly. We've been able to get luckily.
Yeah. Now, tell me on here, you're going out, so you went out and bought one, but how quick did you buy the next one?
So there was a little bit of a lull in between there. I mean, from the time we bought the first one and turned around, it probably took me about 4 months to kind of get the operations underhand. I mean, we took a unit, a facility that it was 92 units. They were all 10 by 12s, no real variety. They were renting them for about $40 a month. The market was closer to about 75, 85 at the time. Today, that same unit's renting for $100. So, I mean, we more than doubled the revenue. The first facility, I mean, this was when I was getting debt for 4.25%. I mean, it cash flowed after a year, almost $5,000. I mean, it really was a grand slam. It was in a flood zone, so a couple of weird things I had to kind of work out, there more or less. But I mean, the cash flow was unbeatable. From there, I mean, I really decided to dive all into self-storage. It took me about a year until I bought my next property. During that time, I was unraveling more or less my residential portfolio. We were selling off the fourplexes and kind of get rid of all that stuff because I'm kind of a big believer of the one thing, focusing your energy on kind of one bucket. So I kind of was doing well in storage and realized I was like, this is the road I want to go in. I'm just going to ditch everything else, more or less, kind of set up my capital and roll. So that's what we did. After that, I bought the next facility, which was 8,000 square foot in, I believe it was October of 21. And then let me see, actually, it was September. And then we bought another one in October. So we bought two back to back. So almost a year we spent unraveling. The next one I bought was 8,000 square foot, and we went ahead and doubled the size. I just took a construction loan and we built that one out to 16,000 square foot. And then the next one I bought was in October, and that one was our largest one. So that one was 38,000 square foot. I actually bought it on owner financing for just at $2 million. It was a guy who was in construction. I mean, we're friends. I'm friends with all of my owner finance notes. We have a couple of them we've done. And more or less, he was looking to kind of get out of the business. I just asked him, I was like, if you're looking to sell this, are you needing cash? And he's like, no, I've got all the money I need. So I said, what if I give you 5% down? So we ended up doing a $2 million deal for $100,000 out of pocket. And then I negotiated a 5% interest rate on a 10-year note. So, I mean, it was, another grand slam, but that took our portfolio from 12,000 square foot to, that was almost 60, 70,000 square foot pretty much overnight. At the time, I was still at the firehouse. So I went from fielding maybe, on the first of the month, 10, 20 calls to the next day I worked was the first, and I missed 75 phone calls while I was at the firehouse that day. So that was when I decided to build out the team that we have today.
That's phenomenal, dude. Absolutely phenomenal. Now, you were doing everything.
Oh, yeah. In the beginning, now the only thing that I tried from the beginning when I got into storage, I realized I did want to do was essentially cut the grass in the day-to-day kind of like at the facility, tasks. So we very quickly kind of delegated those tasks. So I run it's not unmanned, but a virtual model. Essentially, all of our facilities, our goal portfolio right now is between 10 and 50,000 square foot because in my market, which is the state of Kentucky, that's kind of what people expect to run necessarily with not a manager there every day. So that's kind of where we stay.
10 to 50, you have to.
Oh yeah, and that's exactly kind of the market that we stay in, So, but yeah, in the beginning, I was fielding all the phone calls. I used like the services like Easy Storage.
Do you have like a GM? Do you have like one like a GM that goes because if they're all in Kentucky, do you have somebody that you've hired that goes, or is it like contract? How do you do that for that stuff?
From top down, the way kind of our organization works is I'm kind of the COO. I kind of like run the finances and the operations, and I've got two teams kind of underneath me. One's essentially customer interactions, and then the site managers. So our customer interactions, I've got a lady who's been working for us for about 2 years now. Her name's Tina. She fields all of our phone calls. She kind of deals with the customers directly. So she's the customer side, and then we use Basecamp, which is kind of like a CRM to track tasks. So she kind of updates me and assigns tasks to our site managers. So my site managers, I've kind of got a cheat code that I've used for this because of my first responder background. Pretty much everybody, like any firehouse out there, there's a dude that cuts grass. Like that's just a standard. That's what happens. So what I would do is when I would find a property in an area that we were going into, the first thing I do is I drop by the firehouse and I have a little print off and I'd be like, hey, I'm looking for somebody who cuts the grass at the facility. I need it cut 3 days a month essentially. And while they're there, I've got an extra 30 minutes a task. If they're willing to do this, then I'll pay you a flat fee, whether you cut the grass, whether you don't in winter months and stuff. Essentially it guarantees you like a kind of a salary, and they have a series of tasks. So that's kind of been the structure. And I was watching over all of the site managers and coordinating the tasks between the customer side and the site manager side. And now that we've gotten to 7 facilities, one of my site managers has been with us for a long time. I've kind of promoted him to our regional director. So essentially, he handles the majority of the communications with the site managers now. I kind of see everything just kind of to keep it audited. And then he does quarterly visits to all of our facilities. And he's essentially got an inspection form that he completes just to make sure, everything's kind of running how we want.
Amazing. That's very, very basic. But that's how we're kind of structured too. So when we have our facilities that do not have full-time managers on it, it's kind of the same structure. We'll do like these part-time on-site type things where they will go on site for maybe 2 days a week. And then we have our general manager, and then they'll rotate, right? So like we have, the 3 sites, they'll go do 2 days here, 2 days there, 2 days there. And then they'll make sure everything's lock checks, right? All that kind of stuff. But then that divides a full-time manager, air quotations, up amongst a lot of facilities. And then we also have our big facilities that have full-time managers in them, but we'll have a general manager over all those properties in a certain region that kind of oversees them. But we handle our small automated facilities pretty much the same way. And what does your tech stack look like? What are you currently using to do that? You mentioned Basecamp, which I use too. So we've used Basecamp forever. We started out, I really like that. It's a great communication, task management, everything else. I love it.
Oh, yeah. So, I mean, honestly, the name of the company is Simply Stored. Like the whole concept of this was just a very simple company. Like, I mean, essentially, we have great customer service, but very bare bones operations. And, in a lot of the areas we're operating, I predominantly operate in 3rd-tier rural markets, in Kentucky. So essentially within 5 miles of a rural Walmart, that's kind of where we try to go. And what we're looking for is essentially a facility or an area that has a decent amount of facilities, but no real tech stack or infrastructure. So like you might call, but you're not going to get anybody. So our shining star is being the 1st-tier provider in 3rd-tier markets. That's kind of our model.
Oh man, you're warming my heart here. It's like that was my whole business model, man. That was like, when it started up, it was like, I just want to be like, because, and two, as you know, because when we got started, it was like, we're going in these markets like rural Idaho, really rural. There wasn't a Walmart close. And it was like, but there was, let's say a handful of facilities or whatnot, but to outperform was like, it's not even that I'd say it wasn't hard or it was so easy. It was like the most basic things. It's like leverage, right? Like you do little things and it leverages you so far above anybody else that the results are the same. And I tell people, and they're like, the reason why I love it, and a lot of people don't realize this, because when you look at a market, you have supply and demand. And what I'll do is I'll show them, like your model, we'll have rural facilities. And then let's say I go find your facility and someone can call or rent a unit, right? And you have your facility and there's 5 other facilities in a 4-mile radius. Those facilities, though, you can't call or you can't rent a unit online. That means the supply demand is not even. So for a certain segment of the population, you're the only option. So all of a sudden, your demand is so outpaced everybody else's that completely changes the economic of your asset. And I loved that. And I loved that you could leverage it so easy, but your impact on it was so big. And we took the same approach, dude. It was bare bones simple. I mean, you had me, my 2 partners, which out of my 2 partners, one's Sam, who was our COO, he was our CFO and our COO. Then you had me and my father. Me and my father were working full-time jobs during this. So we weren't doing a lot of that stuff. We were more like that kind of I was in charge of acquisitions, right? All that kind of stuff, the sales part. But under that, we had one admin person that basically paid bills and took mail that was coming in, because at the time everything was still mail, right? But outside that, dude, we didn't, nobody. It was like bare bones, we're going to do those simple things really well, and that's it. And it was shocking the results in those markets.
That's a completely our model too, and I always say it's kind of like a guilty kind of thing, but like in these rural markets, it doesn't take much to be the market leader. I mean, just offering basic customer service, to be honest, in a lot of those markets, they have kind of a low standard because the product offering has been low for so long. So just having somebody answer the phone. But as far as tech stack, we keep it very simple. ESS is kind of our base storage, kind of software for right now, easy storage solutions. We use the DaVinci Lock integration. Outside of that, we built our own kind of call system on just Google Voice that we text and call our customers. Our office is not 24/7 either. Our voicemail points them to the website where they can rent or make kind of changes 24/7. But we operate at 10 to 2 Monday through Saturday, kind of text and call line, and we just monitor for emergency situations in between. I mean, if a customer calls 5, 6 times, then it's like, okay, we should probably kind of see what's going on with this. But I mean, that's really kind of the model, and that's what I love is just these rural facilities and going in and just offering a very basic level of customer service that makes you the market leader.
Do you have gates?
3 of our properties are ungated. All of our other properties are gated, and we use the PDK ESS integration, which I mean, it's good. Gates always are just another level of something that can go wrong for the most part.
And that's what I was about to say. Like when we started out, like our properties didn't have gates. And then all of a sudden, it's like there's really no emergency ever. Because as long as they can get in and get out, there's like nothing at all that you need to do. You add a gate, that added levels of people are like, I'm here and I can't get to my unit. Or your gate just broke and I'm stuck in the facility, right? You take away that one thing, and it's shocking how much that reduces any after-hour needs. Like, there's nothing else that needs to be taken care of at a given time because the renter has their own lock. So if they're like, my lock's not working, we're like, what do you want us to do about that? Because I'm only going to cut your lock off. That's it. I don't have another choice here. So it's like it's so limited.
Oh, I completely agree. So, I mean, honestly, we kind of did in reverse. We started all of our facilities had gates, and we kind of kept with that constant. And then the last 3 facilities we bought actually as part of a portfolio were ungated. Now, the main thing I kind of pay attention is to the market. All of the facilities we prior had gates, so it was kind of what was demanded.
Yep, that becomes a standard offering and an expected one. And if you don't have that, then you are an absolutely lower value product.
Oh, absolutely. And I was kind of thinking, honestly, since we hadn't had anything without a gate, that we would run into more issues with the lack of a gate. But thus far, I mean, it's like you said, actually been easier operationally.
Yes.
Yeah. So, I mean, I like both. Personally, now that I know, as long as the market doesn't demand a gate, I personally don't care for a gate because it really, for me, is more of just I don't want to use the word symbol. That's not the correct thing, but it's kind of a placebo of security in a lot of ways. If you know anything about gates, they're very easy to compromise.
If somebody wants to get in a unit, they just hop the fence or they just cut the chain. And this is not, Now, do you have security systems on your facilities?
Yeah, so all of our facilities, we use a camera system mainly that we monitor. So we use cellular solar cameras for our very remote facilities, and that's been one of our biggest challenges, especially with our very rural facilities, is using cellular nodes for the gates. Now, we recently switched over to a new device that we're using. It's a SIM provider that takes and operates on 3 different cellular networks versus before, we were dropping signal constantly. So luckily, using that, it's a lot easier for us to be able to maintain like our security footage and actually our gate communications and stuff now. Because I mean, in some of the places we're operating, like deep eastern Kentucky, I mean, you'd be surprised at the lack of infrastructure there is, for even just cell towers, So we monitor everything. And I have a tech guy that's kind of been with us since the beginning. And every time we go into a facility, we install either, an updated gate system that communicates with our back end software, or either way, we install, cellular cameras and capability. So we have 24/7 recording that records about 60 days at a time.
I got a buddy that does Starlink. So he'll put a Starlink on top of the roof and just drill a hole, and it'll go down in a tubing right to one of the units, and he runs it off that way. So that way, when you can do kind of a patchwork like that, that's an interesting one that I've seen too. And, people are like, oh, that doesn't seem like it'd be a problem and things like that. But in a lot of areas, so for example, Idaho, things like that, when you have mountains, when you're in rural Kentucky, it's not just that there isn't cell, but there's actually like these dead zones where depending on where you're at, it's not good. So lots of times it's not even so much that it's not there, but maybe in this area, it's kind of a dead zone. And two, that might have been why the storage facility was built there. And so that can be an actual thing that people run into.
No, I mean, it runs. We ran into the issue a lot, especially in Eastern Kentucky, just because cellular companies, in particular, like these subsidiary companies, keep trading hands. Like we were on a T-Mobile network, and then it was actually Mint, and they got bought out, and like our cell signal went just to complete crap. So we started using this new provider now that it operates actually on the three main providers, which is AT&T, T-Mobile, and Verizon.
Yeah, it bounces through them.
It prioritizes the highest signal. And since moving to that, it has made a massive difference. But I mean, that's a big thing to consider in third tier markets, especially if you operate virtually, is your ability to actually get your systems and processes in place. I mean, you can fly blind. It's not necessarily like you don't have to have that, but for a level of operation that we have, like you have to be able to.
And it's getting more. So like, even if you look at like, so how we integrate and what we're doing, because the cost of like when we started the keyless technology, right? We were version nothing. Like the version 1 no key that was the first one to come out, right, to do keyless technology. We didn't even have that. That wasn't even ours. Ours that we used was us with Janus wiring units, trying to figure out how this would even work. And so when you're doing that, it was like really expensive. We were wiring everyone individually. We had to put each individual, because we needed a certain amount of wireless. So then to get the coverage we needed, and then they were having problems and everything. So it was expensive, time consuming, everything. Those prices have just cratered and they keep going down. And what that means is that as those prices keep compressing, the third, fourth, fifth tier markets, they'll adapt more. And because then it shifts to being right now, if it's, let's say, $200 a unit in a fourth tier market, you're like, I'm not paying for that, right? But if it's $50 a unit, you're going to go, well, that right there is, let's say, 5 hours a week. I don't have to pay somebody. That makes up for it in, a week. And so all of a sudden you're like, that makes it. So as that continues, what's going to happen is our facilities are going to be more and more reliant on connectivity. And I'm 100% believer in this. And so that means that these issues that you're talking about, things, right, we need to think about and they need to have answers to, because a lot of the facilities that are actually what we're talking about, your system, right, and how you run it, these are the exact problems that technology is trying to solve. And they are in the locations where it's actually hard to make it work. So the very fact that there is the problem also means that you have the other problem and hard to work. So it's an interesting thing where I think most people will run into this more, even though it doesn't seem like they should.
Oh, yeah. No, I totally agree. For the time being, we're examining other products and stuff, but I don't think it's quite there where we can implement it at the level we're at. So we're using like mechanical, kind of devices, more or less like the DaVinci locks and stuff that are not tied to cellular for the time being. But as it becomes more reliant product, and we can kind of justify it with, longevity of owning property, I think it's something we'll kind of continue to implement in stacking more tech just at scale.
Yeah, the connectivity that you need is the phone to the asset. It's the merging that, really, it's been going on for a while, but particularly in real estate and other things, the merging of hardware and software. Right? That's what we're talking about here. So I think that how you're using, which other people use, we have used, and like the DaVinci locks or these other separate types, there's a few different other players. That is so you don't have to have the merge, but you still get the outcome. So instead of merging the software with the hardware, you still get the automation part, which for now, that is one of the most viable things, hands down, in fourth tier markets, because even still, like with the Janus products and stuff, lots of those markets, they do not justify high enough revenues to make it worth installing that kind of hardware into the asset.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class when dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process. They are bar none the best. So if you are looking to automate your facility or operate it in a best in class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
Like you have 80 units in a market that has 40 cents a square foot in revenue, that will never pencil, right? It just doesn't make any sense.
No, I completely agree. And, Kentucky, it's very interesting as far as a market standpoint. When you sweep from Western to Eastern Kentucky, the prices dramatically change. I mean, in Western Kentucky, like a 10 by 10 might still be like a $50 unit. Whereas in Eastern Kentucky, in some of our primary markets, we're getting 85 to 95. So, I mean, you're almost talking of a swing of like 2x of revenue, depending on what geographic area of even Kentucky you're looking into. And then of course you've got your submarkets, everything like that versus first tier and, second tier. We do have one second tier property, which is south of Lexington in Nicholasville. And that's actually been one of our more challenging ones from a financial standpoint to operate, just because there are larger players in the area, so we've got like prime storage and public and all those. So like we have to run specials, which is really difficult as a smaller operator to keep up with kind of their algorithm, because that's not our model in the more rural markets.
And two, this becomes a really hard thing that I think people are struggling with, and they found, because the smaller facility in big markets, it's not so much even the size, anything else, but your cost per acquisition is astronomical. So when you're dealing in large markets where you have extra space, when you have prime, when you have even people like us, what's happening is when we first moved to a digital platform that we were acquiring our customers, we got rid of yellow pages and it was like $10,000 a month, right? Our cost per acquisition was nothing. It was shockingly low. And we thought, oh, this is going to make it right. Today, our cost of acquisition is higher than it was in hard print. Like it's actually more today than it was to put it in yellow pages and do the news or commercial, things like that, because the cost per click has skyrocketed. And so all of a sudden, if you're a small facility, you can't do dynamic pricing and you can't do volume because there's not enough units to leverage it like the big boys can. And then that really makes it struggle because you don't have the ability to offset because you don't have as much units. It's different when you have 400 units. And you can then leverage pricing and you can churn through tenants and get the highest one. And, you only have 80 units and all of a sudden you can't do that. So it makes it a lot more challenging.
Yeah, for us from a, kind of an advertisement and like customer acquisition standpoint, we kind of take, I want to say it's an old school kind of mixed with a new school kind of approach. So like we're kind of actually targeting, the like Facebook marketplace ads and like the Google ads. And then we also actually like advertise physically at a micro kind of level. So we'll actually do town, like a lot of the town, Kentucky has tons of counties and towns. So we actually support a lot of local events. And then there's also, a lot of your little diners and stuff will have a rotating TV that have advertisements. So we target a lot of kind of the micro advertisements because, we know we can't necessarily beat on reach, but we can beat on, kind of a specified customer pool and, kind of the customer service that we're trying to bring. I can never beat them necessarily. Yeah, I mean, that's what you have to do. We take a very micro approach.
Because the big guys aren't doing it. So you're getting a segment of the market, even though people are like, oh, but that's a small segment. You're like, yes, but it's a small segment, but the big segment is being dominated by big players and I can't compete. So it's actually smaller than this small segment because none of them are doing it. So the leads that you'll get from that, you're not really competing with anybody else. And this is like one of those marketing techniques and things that you look at where it's like, how you're doing it. I love, first of all, how you pinpointed your customer, like how they act, how they work, how they do. And then you're doing what others aren't. And so you're getting a separate pool. And that's how you zig when others are zagging, so to speak, right? And that makes all the difference. It really does. And especially in small communities, things like that, that stuff, like, it's different. Things in the smaller the communities aren't nearly as transactional. And I think a lot of people forget that, especially big players. They move into the small facilities and they try to do dynamic pricing. And you're like, you brought somebody in at $50 and then you move their rate to 100 in 3 months. They leave. There's not a lot of people to replace them. And two, then they go around and they bash on you. And now they've told 20% of the entire population, you can't do the same things, because in big markets, you can very much be transactional and it doesn't matter.
Oh, absolutely. So, I mean, that's kind of our approach in third tier markets. We don't really do a whole lot of dynamic pricing. I mean, for the most part, our rate is what our rate is. Now, we run certain specials and stuff that kind of, fill up at certain times. We bought a facility that was in really rough shape, renovated it last year, and it launched in October. And that was about 90 units. And over a period of about 4 or 5 months, we took that to 96% occupancy just by running a rent one, get one half off special. Just being the tech player in the area. But I knew going into that market when we acquired it that the, average supply versus the demand, we were at the whole county level, like 4 square foot per, capita. So, it was way under supplied. Yeah. So we very quickly filled that one up. I was super, super happy with that one. That one was a crazy deal within itself. Believe it or not, it was a foreclosure. The property was inherited by a brother and sister who lived on different parts of the country, Florida and California. Kind of family was successful. The kids inherited a lot of money, had no interest in running the family's businesses. And long story short, that resulted in this 16,000 square foot facility we picked up for $195, end up foreclosed. So, my all-in price per square foot for this, which I consider was like a B-class facility, was $30. In the end, it would cost me $65 a square to rebuild the same facility. So, that's kind of our approach too, is like when we're looking at these markets, we're a quality versus quantity, so our deals, we don't do a whole lot, but like the deals we do are very, very strong deals.
That's exactly how, we've always been too. It's like even how we work with development. It's like, I don't do a lot of developments for a firm our size. I think it's actually kind of surprising how little we do. But when we do them, they're strong deals. Like we expect huge things, and that's why we do so little of them, is because they have to meet our requirements. Okay, so I know everybody, we're going really deep in the weeds here, which I love. This is like, dude, I could talk to you about, we could get into like close rate and like all these thoughts that I have like in small communities on how like even the justification of rate increases, like we're very transparent with our rate increases in small markets where we're like, hey, everybody, we bought this facility. We're changing things. We're doing it. But we bought it. The cost of our acquisition is obviously higher than the other person's. We have taxes. Our insurance went up. So we are raising rates because we have to due to taxes and insurance. And we actually tell them why. And a lot of people, they really respect that because they understand that. They get it. They have costs, things like that. Where in big markets, I would never even have a conversation with somebody about why we gave a rate increase, because it would be, why'd you give me a rate increase? It would be because we felt like it. There's no other reason why. We don't even care.
It's the exact same thing for us too. So the 3 facilities we just acquired, they were on the rural market, like with most people paying checks and like very little communication by phone or email, so that's the same thing. And to be honest, when we send that initial takeover letter, we go ahead and tell them that there'll be a rate increase in 30 days. And we just rip the Band-Aid off. And people have asked me in the past, why do we do that? And we just tell them, they expect it. Like if somebody's taking it over, they're expecting it. I'd rather tell them in 30 days that's going to happen than them get comfortable and like 3 months down the road, pull the wool over their eyes. So we just do it right out the gate. But to be honest, we went from all 3 of those properties having like an average occupancy of 95%. I think the lowest we did at our largest facility, which was almost 200 units in that market, was 88%. So, we're talking about, taking the 10 by 10 unit from like $55 to, $85. So, a significant increase for a lot of customers. Yeah. And still like less than 10% turn. That's significant.
We see that too. When we picked those facilities to do it, we had one where it was actually, it's crazy because it was owned by the state. So they paid no taxes and they paid no like admin fees. They got basically everything for free. The government owned it, right? So they had their rates at half of the market's rate, and they were actually pulling rates in the market down. And so the state got sued over it. They're like, you're competing with for-profit businesses that they have to pay you, And you can charge half the rate because you have half the cost basis. Why do you have half the cost basis? Because your competitors are paying for you to have half the cost basis, right? Really bad. But when we took it over, we gave a rate increase. Our average rate increase, dude, was like 70%. Some people got a rate increase because they'd owned it for a decade, and they because they were the state, they would never give rate increases, and they were at like 90% full. Well, our average rate increase was 70%. We were very open with them. We said, the government owned this. We're taking it over. We're making this done right, but we now have to pay taxes, everything else. People got mad, right? But at the same time, in a 5-month period, we were at 96% occupancy. So our occupancy rose, even though we almost gave an average double rate increase. And that was sent the day after we bought it. But we closed that night, and we sent it out the next morning.
Oh yeah. We use a certain like a kind of a letter sending software platform. So we schedule it like same closing day, and as long as everything goes to the plan, it shoots out that next day. So that's the same kind of model we'll say. But 2 points on that. Like you were mentioning, rate increases. We do the same thing, but it's a respectable rate increase. I don't want people to think like we're coming in and gutting. Like we're pricing to the market with, kind of our surrounding competition, and sometimes even lower. And most of our customers too, we offer usually a $5 or $10 discount. So like what we'll say is like, hey, like the unit you're in is $65 a month. It's going to be $95 a month because you've been with us. We're going to get it to you to $85 a month if you decide to stay with us. So we give them kind of an existing customer discount, and that kind of keeps us sticky, in these third tier markets too. And then your point two, speaking with, like that state owned facility, I've seen it in the private sector. There was a certain town here in Kentucky. I went and looked at a property that I could have built for, $60 a square foot, and they were wanting $35 a square foot for it. I mean, it was a deal. It was built within 5 years. But the problem I ran into was that property was 10,000 square foot, and the next competitor in town was 110,000 square foot, and they had been in business for over 60 years. It was family owned, and they had no debt. So they were holding down the market, and the same thing. There's just no room for growth because they had no overhead.
We have the same thing in our markets. This is a huge, I'm talking Boise, Idaho. So this is 800,000 plus people live right here. And you had two families that got started in the 70s. They bought their land, and their mode of operation was we make up in volume instead of prices. We have like no debt. We have the land free and clear and have since the 70s, huge, vast tracts of it. And the city grew around it. And so they'll build hundreds of thousands of square feet, and they'll keep their prices at dirt, like literally like nothing, right? They're talking a third of the market, and they can get away with that because they have no debt, they have nothing, and they have, 2,000 units at the site. But that had suppressed our market for decades, right? And that didn't change until literally, some people, we came in before there were REITs, and we started to get aggressive, and then the REITs came in. But that really, it took, our market had to grow to a certain point to where it could overcome that.
That's exactly it. So yeah, kind of when I run into that, a lot of times if it doesn't pencil, my next stage is just to start marketing that 110,000 square foot mom and pop.
Yep.
They become my new priority. And for me, my marketing, whenever it comes to actually trying to acquire facilities, we have a very organic model, and I call it relationship marketing. So like all of the people that I work with that we're targeting their properties, we've been speaking with now for more than 2 or 3 years. Like I the other day called and was like, hey, how was your Father's Day weekend? Like we have real conversations with people. I have meetings and lunches with people, and our pitch is always, if and when you're ready to sell, we just want to be that phone call. So we take a very relationship kind of style of trying to source our properties, but we mainly do, a value add acquisition strategy.
Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you.
Okay, man, we've gone into the weeds stuff. This is so valuable. I absolutely love this. Now, I want to hit on some upper level stuff. You have your kind of model that you've developed. I mean, what an absolute win of a year for you in life changes. 27, you have your own business. You can employ yourself. You have new family, new baby. Congrats again. What are you trying to do, man? You already have 7 facilities. You're talking 800 plus doors. Oh, what is this? It? Did you just like, hey, I achieved this, and I've got my freedom now. I'm going to optimize, and I'm spending time with the baby and the family, and I'm traveling, or what? Talk to us about that.
So I'll get deep on this because I'm a very big believer of, kind of setting your goals and like trying to see how that aligns with your life. And I evaluate everything on how it affects me in 3 realms, which is, happy, healthy, and wealthy. I'll tell you, I'm in a season of transition because the last about 6, 7 years that we've kind of been pushing this real estate, the whole goal was to get to this point. And now that I'm at this point, I am kind of struggling with what to kind of do next. But I will say that the beauty of that is that we're at a point with the business that before I was hunting deals to feed, essentially my family. And we're at a point now that, honestly, I'm comfortable living on about a third of our net revenue, that we make from the company. And that was what I wanted to be because I didn't want me quitting to be a point where the business could no longer support itself for growth. So kind of what we're doing now is we're continuing that quality over quantity, model. We're still looking for deals. Our underwriting's tightened up a lot just between, what we don't have to necessarily, kill every deal out there. And then also just, the market in general with interest rates. So, I mean, we're still buying. I brought in more team members to help me with the acquisition side. I just hired, shout out to Trey Hatfield, my acquisitions dude. He's kind of more or less helping me find properties and managing our cold and warm leads. And I kind of follow up on our hot leads now, but I'll tell you that has freed up a huge amount of my time. So we're still growing. I'm just now using my resources to outsource and delegate certain tasks that I don't necessarily have the time for. Like I can't, sit and make 60, 80 phone calls, a week now, having the baby more or less in my arms, so that kind of stuff I'm outsourcing. We're still doing Kentucky. I don't think for us, I'll really get into much new development. Reason being just because the cost versus, the fill up rate and stuff it's a risk I don't have to take as much as I like it.
And especially in those markets. I mean, for us, we won't touch a market that we can't achieve legitimately in-place rates, not street rates. But if we can't get in-place rates up to $2 a square foot a month, so $24 a square foot a year, we won't develop in it. Because I'm like, it's too much risk and it won't pencil because costs have gotten so much that it's like, hey, now I'm talking about building big, nice facilities in big markets, people. But of course, it's different if you're doing gravel, that kind of stuff. But it doesn't, even if you are, the cost to build is so much and demand has changed so much over the last 2 years. It's not the same thing. This is not like 2010 to 2020 development anymore. Those days are gone.
No, I agree. So kind of the model we're pivoting towards is trying to acquire small portfolios. So, kind of more bang for your buck, like buying 2 or 3 at a time is one of the things we're kind of targeting. Whereas in the beginning, we were trying to buy one-offs, more or less. And then the other thing too is just finding properties that have development potential. So, like raw land, like I'm perfectly good with buying the property, getting the revenues where I'm wanting to, and then dumping that revenue to support the expansion of it for a couple of years. So that's kind of what I do is like I'll buy a property, get the rates where I want it. And then once it's cash flowing a certain amount, then, I'll be like, okay, this one's just going to be a net zero. Let's use that cash flow essentially to justify building. And then, a couple of years down the road, we'll let that one be more profitable. So that's kind of what we do too, is the buy, improve, develop, kind of model. Outside of that, like we're real comfy in Kentucky. It has our lien laws are very standard here. It's crazy. If you go into Indiana, the lien laws are completely different. I almost have to build a separate team to operate just in the state of Indiana, which is 30 minutes north of me, because the lien laws are different. But Tennessee is very close to Kentucky and has made some changes to kind of adapt that. It's an extremely hot market, but I think organically growing, we'll continue to kind of seek into Kentucky. If we decide to go in any states, I'm going south, not north, just so I don't have to deal with snow. We don't have to deal with a whole lot of that here.
That's expensive.
Yes, I've heard your horror stories with that. So that's one of the reasons I won't go much north either. So I really like the southeast kind of corridor. Alabama, Georgia, Florida's way too hot. Tennessee's really hot too. I really like Alabama, but I think what we would probably end up doing if we expand next is enter a state, probably try to buy a small portfolio of 3 or 4 properties to justify the expansion. build a new team, and then spend several years expanding into that market. So, I mean, it's kind of a test and expand model.
Yep, that's how we are too. We take the same approach. We go into a market because of our beliefs. The beliefs are confirmed by the performance. We build out from there. Operations leverage them, and I love how you've pinpointed kind of what you want, how it molds into your market. I tell everybody you have three buy boxes. You have a buy box of the asset, and the asset is size, right? How it performs, right? All that kind of stuff. You have the market buy box, and then you have your strategy buy box. And now there's another buy box for those that are syndicating, and that's the fourth one, and that's your investor buy box. And if these four things, or the three things, if you're starting out or you don't have investors, if those aren't aligned, that's where you get problems. And what I'm hearing from you is very much alignment within your strategy, the market, and the asset. And that's why you target it, which that's a recipe for success. It just is. Because you get better and better the more you go along, because you understand it, you get it, you move forward. And that's been a big thing with us, right? And that's how we started. We just like, hey, we know what, this is our market, this is our buy, this is what we understand. And we got better at it, and we leveraged it. So I love that. You're on the right path, man. This is exciting stuff. You're going to be, it's going to be amazing what you're going to accomplish. By the time you're 30, you're going to be further than I could have ever even imagined by the time, I was 30. And that gets me really excited.
No, I appreciate that. Yeah. I mean, the other cool thing about it too is I don't have any investors. I own 100% of what we have.
And that's how I was too. For 15 years we grew, and it was just us. And then we obviously changed, but yeah, no, that's same thing.
And we use your bird model essentially. I use a combination of two things, which is essentially, the bird model, which we've kind of flipped our capital over and over. But I really am hot and heavy on owner financing, and I love owner financing deals. I've done a lot of those. I just recently did our first sub-2 deal, which we'll be converting over to an owner financing because we're actually paying off their other debt and stuff. So, I mean, like, I've done a lot of creative.
Shoot. Okay, guys, everybody, don't worry. We're going to do another podcast with you because I want to do just sub-2 owner financing. Check it out. I can't remember the financing chapter in my book, though. I put in, because you just got it. We were talking about it earlier. But I have a seller financing deal on an $8 million deal and a population of 2 million. And I break it down and show the difference of like what we were getting offered. Not so obviously we've already been on for an hour, but we'll have you come back on, because I'd love to do one just with sub-2 seller financing that we can talk about and go through your numbers, and I can show mine, because that's cool. I like that, dude.
Yeah, I love those kind of structures, and I'd be more than happy to dig into that. I always kind of pitch it as that owner financing is a partnership deal. It's just that they're the silent partner, and that's what we do. But I mean, all the people who are owner financing, I mean, I have regular lunches with them. I send cards for holidays. I mean, like, they're friends. And I mean, I kind of told them too, I'm like, look, if and when I pay you off, hold on to that money, because then we'll talk about something else, so I mean, that's kind of the structure we do. But yeah, I love that structure. I mean, it's really an opportunity for everybody to win.
Once again, dude, we could talk about this. We'll have you on again. You need to make sure you're up at the conference. Maybe we can do a small facility segment, and maybe I'll have you come speak on that, because this is really relevant today and what's going on. I love the simple part of it. I love the execution. You're obviously being successful, and will continue to be. So where can people find you, man? Where can people follow you or learn more or reach out to you?
Yeah, I mean, really, I have a landing page. It's just DillonLeonard.com. It's mainly for like inflow of deals, but I mean, it's got my contact information and stuff on there. I don't really do any of like the, guru-y kind of teachy stuff. That's not really my thing. I'm more than happy to give resources, but like, my thing is always there's knowledge and power. So like, if you ask me a question, I have time to help you. That's just kind of the way I am. Now, that time is becoming less and less, these days and stuff. But I'm always happy to help anybody any way I can.
Awesome. We'll put that link below. And thank you, dude, for sharing your time with us. You have a new family. You're now not working a job. You got your own, and you got a team, everything else. So we appreciate you being open and sharing what you're doing, because a lot of people they won't. they don't want to give away their secrets, as people would always say to me, AJ, why are you giving away all of your secrets, right? And I'm like, I don't know why I wouldn't, because the opportunity comes back to me, right? And so I love that you take that approach too, and you will be so detailed and open about what you're doing.
No, I really appreciate the opportunity, and I think just the feedback on what you're saying. Yeah, the execution is the secret. I mean, as long as you get people information, it's there, but the secret is taking the action to implement it. So, I mean, that's what differentiates people.
Which you obviously did. We were talking about my first book, and I'm like, man, that's why it gets me excited, because I'm like, you took it's like you did it. And that to me is powerful, because to me, that's where I'm like, what we're doing here, what me and you are doing here, right? Somebody else is listening to you right now, dude. And then you're going to find out, like, it's been 5-6 years since I wrote that last book. You're going to be talking to somebody, and you're going to hear the story about how they now have a family. They left their job to financial freedom, and they built that stuff. And that is powerful to me. It's like, it means that it's worth it. So thank you for paying that forward and giving it back. I really do appreciate it.
Oh, absolutely. And I seriously appreciate you as well. I mean, that's your legacy, and that's kind of the legacy I'm trying to leave is just being a resource for people. So, I mean, thank you for all the content you've put out there.
Got it, man. And we'll have you back on so we can talk about sub-2 seller financing deals and self-storage. So we'll talk soon.